Guys, huge news in the stock market today. If you guys are paying attention to the stock market right now, it's absolutely plummeting. And let's take a reason. Let's take a look, and let's also look at the reason as to why it is. I'm Rhett Weaver with Intralend Utah. Hopefully, this kind of breaks down and gives you some insight on what's going to happen tomorrow on the Fed meeting, and also what could come of this with interest rates. We've been predicting May 10th is our day. We may start to see it a little bit sooner, and here's why. Right behind me, if you just go ahead and Google and take a look at regional banking stocks, if you look at the stock market today, absolutely getting destroyed. These regional banks are under too much pressure. A lot of them are down almost 30% right now, and they actually had to freeze the stocks of these banks because they're plummeting so bad in preparation for tomorrow's announcement that the Fed is going to raise interest rates by 25 basis points, which is only going to add more pressure to all of these banks. We saw banks over the weekend already get bought up, and they basically had to liquidate. So we're going to see this continue, and at what cost? Tomorrow's Fed announcement, when they raise the 25 basis points, it's all about really their comments and how aggressive they're going to be from here on out. If they go ahead and identify that there is a problem, we're going to see interest rates get lower. Then again, we're going to have the BLS jobs report on Friday. Sounds like unemployment's going to be higher than what they're predicting, and also job creation is going to come in lower than what they're predicting as well. We could see interest rates get even better by the end of the week. And then that leads into next week with the CPI report or the inflation report. And this is the one that we've been waiting for, where we've been waiting for the shelter to come into play, which is 43% of that. So pay attention this week. There's a lot going on, but today you're seeing stocks plummet, and that's why we're seeing interest rates get a little bit lower. I want to break down some data on the housing throughout the United States, how much equity people have inside their homes and how much debt they're running into right now because the Fed continues to raise rates. Let's take a look at this. Here is a chart where you guys can see personal savings account versus credit card balances. These three peaks that we're taking a look at right here is when COVID got their relief money. When everybody got the COVID relief money, they got it three separate times. Look at what happened to credit card debt. It went down. Right now, credit card debt's at an all-time high and interest rates are over 20%. The other thing that we need to take a look at is over here on the far right, which is car payments on average are $800 a month. That has doubled in the last 3 years. So even with all this COVID relief money, when everybody went out and bought anything, the stimulus packages, what ended up happening is they ended up going out and consuming a lot of debt on variable interest rates. And those variable interest rates are now taking a huge hit. And this is why we're seeing the banking crisis and why the bankers are starting to fold. But here's something that's very intriguing that hopefully you guys will pay attention to. Right now, on average in America, people have 42% of their home remaining, which means they have 50% of equity in their properties right now on average. So we're going to see a lot more people going into taking out, home equity lines, second mortgages, cash out refinances. We're going to see people start to liquidate their properties because of the consumer debt that they have. And let me show you why. It's not uncommon to see this right now with people having almost $50,000 of credit card debt and typically one car around $35,000. So that's $85,000 of consumer debt that we're seeing nationwide. Right now, because all of these payments are on variable rates, the payments have gone up and they're right around $2,300 a month. So the question that I'm getting right now is, Rhett, I've got a 2.5% interest rate. I got a 3% interest rate. I got a 4% interest rate. Why would I take that rate from 3% and move it up to 6.5%? That seems like the dumbest thing I've ever heard of. Here's the problem. The reason the banking is having a huge crisis is because everybody was liquidating their cash out of it. That's why the savings is down so low. And that's why people aren't depositing enough money versus the withdrawal of monies. And that's why the banks are failing right now. So if people have been liquidating all their money to make these payments as they have gone up, when they run out of cash, what's the next alternative? If we take that $85,000 and chew up some of their home equity, go from 43% up to 70%, they would actually be saving, if they cash out refinance at 6.5%, they would be saving and netting $1,000 a month. And so you're like, okay, Rhett, I get it. They went ahead, they consolidated their debt, but they still took a 6.5% interest rate. Why would they do that? If they take that $1,000 a month that they're now currently saving, that they would have been spending on the interest, right? Remember, these are variable interest rates and their payments have gone up because the interest rates have gone up. So if they take that $1,000 that they're going to net after consuming all their debt into a mortgage loan on a cash out refinance, take that $1,000 extra, instead of saving it in their bank account, they apply it to the new principal balance of this mortgage loan. This is why you would go from 3% to 6.5%. If they do that, take that $1,000 on a principal reduction per month, that new loan of 30 years will be paid off in 15 years and 4 months. If you don't do this per se, and let's assume you stay on track, which is probably 27 years to pay off your mortgage loan at 3%. And the argument's going to be, well, Rhett, that's cheap money. My argument back is, well, people are going to be in a really bad position here really soon because they ran out of their savings account and they have to do something. If they remained on 27 years at 3% making their mortgage payment, the same period of time that they could have paid their mortgage off with that higher interest rate and the net savings and applying that towards a principal reduction, they now will have 15 years left in a $286,000 principal balance if they remain just making the monthly mortgage payments on that 3% interest rate. This is why people should look to consolidate their debt, try and save a little bit of money, and then figure out how to pay things off a little bit quicker. So for you guys out there that are talking to a lot of clients, they may not be expressing the pressure that they're running into right now. If they got a home equity line and that payment, that interest rate's gone from 4% to 10%, or if they're running into a lot of debt right now on variable rates as far as credit cards or consumer debt, this is the reason they're going to sell their house. This is the reason they're reaching out to potentially refinance. We've got to understand that going from 3% to 6% isn't just about paying off a payment or having cheaper debt. This is about taking those 20% interest rates or those 11% interest rates that used to be a lot lower and basically consolidating them into one and going from 3 to 6 to help your consumers save more money every single month. Hopefully this kind of helps you guys out. Here's what we're kind of up against as far as the bond market right now, and kind of the overall what's happening with interest rates. So you guys can take a look. We're up 40 basis points. It's a huge move today. We've had each one of these lines as a barrier that we have to break through. Typically, there was always some type of resistance to get through them. As of right now, we've broken through 4 of them, and we're trying to break through the last one. This will be huge today if we can get through it. If we can't, odds are in the Fed meeting tomorrow, we're going to get there. And so if we can break through this, there's a ton of room to the upside to the very next stop. This means interest rates are going to get a lot lower very, very quickly if the Fed meeting tomorrow comes out. And all I'm going to say is based off of what's happening in the stock market today, we're going to get some great news with the Fed tomorrow because there's just too much pressure that's going on. Stay tuned on this. Let's pay attention to this, but interest rates are only going to get better from here on out.